Hi guys. Today we will analyze automatic data processing stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $196 and $178. Next strong support levels are around $160 and $150. Strong resistance levels are around $218 and $225. Next strong resistance levels are around $238 and $248. In the last month the stock has been trading between $196.60 and $225.20 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1.8 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 113% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for automatic data processing company: bad, average, and good. First scenario. ADP will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 14%. Future free cash flow to net income rate would be low, 90%. In this case, the fair value of the stock today would be $116. Second scenario. ADP will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 15%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $135. Third scenario. ADP will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $156. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.77. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For automatic data processing, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 30. Again, I will use 3 different scenarios for ADP company: bad, average, and good. First scenario. ADP will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future PE would be low, 18. In this case, the fair value of the stock today would be $74. Second scenario. ADP will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 21. In this case, the fair value of the stock today would be $94. Third scenario. ADP will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 24. In this case, the fair value of the stock today would be $116. As you can see, today the stock is overvalued, $207, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower before it recovers. The company is a dividend aristocrat. I may consider buying the stock for the dividend when the stock drops to $140. Company's strengths. Automatic Data Processing is an American, leading cloud-based provider of human resources management software and services. It offers industry-leading online payroll and HR solutions, plus tax, compliance, benefit administration and more. ADP provides its services to more than 920,000 clients in more than 140 countries, including North America, Europe, Australia, Asia, and Brazil. ADP has retained high revenue retention and improved operating margins over the past decade. The company also generates earnings from interest on funds held for clients. The company benefits from high client switching costs, a scale-based cost advantage, intangible brand assets, and a powerful referral network. ADP remains well-placed to benefit from near-term industry tailwinds, including tight labor markets, dispersed workforces, and increasing regulatory complexity, driving demand for solutions to attract, manage and retain employees, and outsource HR functions. The company has a solid business model, high free cash flow and low debt. ADP's dividend yield is average at 2%, and has been increased for 47 years in a row. The company is getting close to being a dividend king. ADP's return on equity of 68%, return on assets of 4% and profit margin of 18%, are amongst the best returns in the industry. Risks. The overall health of the economy. A reduction in employment and decreased spending on payroll processes and services could slow the company's growth. Exposure to changes in government regulations. If the company's time allotment for paying taxes, or the total percentage of taxes withheld declines, ADP's interest income could be at risk. Furthermore, ADP's low borrowing rates would likely rise if its credit ratings decline. Any share loss to new emerging competitors could also pressure bookings, retention rates, and income earned from client funds. The company must maintain high levels of investment in software development and innovation to combat increasing competitive pressures. ADP handles high volumes of sensitive information, exposing the company to data privacy and security risk. If a data security breach or breaching of data privacy laws was to occur, ADP would be exposed to regulatory fines, civil lawsuits and/or reputational damage. Exposure to the European economy. ADP's European operations typically account for 10% to 11% of total sales. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.